Welcome everybody to this session of the Indiana Leeds Summer Tax Workshop Series. I'm Leandra Lederman, the William W. Oliver Professor of Tax Law at Indiana University Maurer School of Law, and I'm really pleased to be co-hosting with Dr. Leopoldo Parada, and I will now turn it over to him to introduce himself and today's speaker.
Thank you, Leandra. I'm Dr. Leopoldo Parada, a lecturer in tax law at the University of Leeds in the UK. And I have the pleasure of introducing today Mike Devereux, who is a director of the Oxford University Centre for Business Taxation, professor of business taxation at Saïd Business School, and a professorial fellow at Oriel College. He was elected president of the International Institute for Public Finance for a 3-year term in 2011. He is also a research director of the European Tax Policy Forum and a member of the board of academic advisors of the International Tax Policy Forum. He's also a research fellow of the Institute for Fiscal Studies, the Center for Economic Studies, and the Center for Economic Policy Research. He is assistant editor of the British Tax Review and sits on editorial board of the World Tax Journal. He has also been previously editor-in-chief of the International Tax and Public Finance and managing editor of Fiscal Studies. Mike has made a significant contribution to the tax policy-making debate in the UK and internationally, especially through the EU Commission, where most recently he was a member of the European Commission high-level expert group on taxation of the digital economy, the OECD and the IMF. He is a member of the Government Business Forum on Tax and Competitiveness. He acted as a special advisor to the Economic Affairs Committee of the House of Lords on its inquiry into corporation tax in 2013. And I will stop here because I will continue the whole afternoon introducing Mike Devereux. I'm very pleased that he can join us today and will speak about the OECD GloBE proposal, the Global Anti-Base Erosion Proposal, and evaluation. So Mike, thank you so much. And now the floor is entirely yours.
Okay, well, thank you very much, Leopoldo and Leandra. It's a pleasure to be here this afternoon, in my time at least, joining you. This is a great initiative, the seminar series, and it's fantastic that so many people attend each week. So I'm very grateful to you for inviting me to take part in it. What I'm going to be talking about today is the OECD, some of the OECD's work, especially on the Pillar 2 side. And this comes from a report which I wrote with many of my colleagues at the Centre for Business Taxation in Oxford. So I'm going to put up some slides so that you can see some of the things that we have been thinking about. And I'll present those, and then I look forward to having a discussion with you. I should say it's great to see so many friends and familiar faces on my screen here, on my several screens, in fact. So I wish we were meeting in person, but we'll have to make do with Zoom, I guess. So let me share my screen and see if I can make this work. So as I say, this talk is based on it's on a paper and a CBT report which I wrote with several members of the Centre for Business Taxation. The centre is relatively small, and actually these are most of the members, so you shouldn't have the impression that we're a very large institution, and this is actually pretty much all of us. So we did this collectively. The centre has economists and lawyers in it, and the paper is really kind of draws on both law and economics. So this is what I thought I would talk about. And the whole paper has 3 sections. So the first one is policy issues, and that's really what I thought I would talk to you about today. There are 2 other sections which I can mention and answer questions on if you would like to ask anything. But one is, what's the effect on total revenues of implementing this particular proposal? And also, what are the effects on incentives to invest and locate and to shift profits? So those are kind of 2 separate issues which I was going to largely leave to one side and just focus on the policy issues. So here's a list on the slide of what I think are some of the interesting questions that we might ask. So I really want to set this, but let me say at the beginning, I really want to set this into the kind of big picture. What I really like to focus on is, why do we think doing this at all would be a good idea? If you read OECD documents on Pillar 2 and what's being proposed, you see a lot of technical detail. You know, how are we going to make this bit work? How are we going to make that bit work? But we see very, very little on, why is this a good idea? Why would anybody want to do this? And that's really the main thing I want to address. I want to talk about that in kind of broad terms, then come down to kind of some of the specifics, but still at a kind of relatively high level. So if you're kind of looking for kind of very detailed analysis of some of the things, you're probably not going to find it this afternoon. So apologies for that. I want to kind of address things at a broad level. Now, as we all know, the OECD has 2 pillars going in different directions. I want to ask, you know, why is Pillar 2 sensible? Or indeed, you know, is Pillar 2 sensible? Might be a more direct way of asking this. So what's it trying to achieve? Who gets to tax the profit? Some specific issues on measuring the effective tax rate on blending and so on. And then what seems to me to be very important at the end is what I'm going to talk about: incentive compatibility. And I'll explain what I mean by that in due course. Let me start with this. So this is something I've put up for my students when I talk about tax. For this audience, it may be somewhat basic, but I think it helps to kind of illustrate what the kind of broad principles that I'd like to address. So if we think about a multinational company, we want to tax the profits of a multinational company. Where could we do that in principle? Let's kind of start with a clean sheet of paper and say, suppose we wanted to do this, where might we do it? Well, it seems to me there's 4 different places we could do that. We could say, okay, well, you know, really what this is a proxy for personal income tax on the capital income of the owners. So let's think first of all of the shareholders. So we could, you know, if we could do pass-through treatment of multinational companies, we just allocate all the profits to individual shareholders and tax them there. That would be taxing on the basis of the residence of the shareholders. Now, you know, that may be difficult. So let's, you know, I'm not going to talk about that option very much, but at least we can consider that as a possibility in principle. Then we could say, okay, well, no, we could tax this. There's one place we could tax, that's the headquarters or the parent company. Let's go to the ultimate parent, figure out where it's resident, tax the worldwide profits there. You know, that if we could do that, maybe that would make a lot of sense. Third, we can think about all the affiliates, you know, permanent establishments, subsidiaries, all kinds of things. They're owning all sorts of assets, transacting with each other, doing production, finance, R&D, and so on. All of those kind of things I'm going to call affiliates, and say, okay, they're all over the place. There are many, many of those all over the world. And finally, there's sales. Okay, so where do you actually make a sale, in the sense of, where's the customer? Where is your customer buying something from you? Seems to me that gives us, you know, let's think about that in broad terms. So to start off with, you know, where does the existing tax system do this? You know, when I ask my students, they usually get it wrong, but I hope that you wouldn't. So I'd say we mostly tax here. You know, we try and allocate, we think of in a kind of residence and source basis. When economists think of residence and source, they probably think of residence being the residence of the shareholders, maybe the parent company, and maybe combine those 2 together, and source as being where all the stuff happens. Residence and source in legal terms and the actual practical implementation of the world is primarily where affiliates are. You know, there are places where the US guilty provision says, okay, we're going to tax in the location of the parent, maybe some CFC rules will be doing something similar. So I've said I'm going to do this at a broad level, so this is maybe particularly broad, but let me carry on. I'm going to slightly less broad, but not much. So, okay, this is where we start, I think. Okay, so the OECD comes along, or rather the members of the OECD or the inclusive framework come along and say, actually, we're not very happy with some things in the international tax system. We want to change it. So we have Pillar 1 and Pillar 2. I'm not going to say anything about Pillar 1 today. But Pillar 2 is called the Global Anti-Base Erosion Proposal. So which the title is quite interesting to start off with. So what is this supposed to be doing? Is it supposed to be attacking base erosion? And perhaps, we could have a discussion of what's the difference between base erosion and profit shifting. There's a subtitle, which is It's addressing tax challenges arising from the digitalization of the economy. That's kind of left over from BEPS Action 1, but doesn't really seem to apply anymore. Nobody's suggesting we just do this for digital companies. So what's it proposing? It's proposing two main features: an income inclusion rule. So that says, as it says here, we're going to tax the income of a foreign branch or controlled entity if that income was subject to a low effective tax rate in the jurisdiction of establishment or residence. So that's the main element I'm going to be talking about today. That's the kind of really big bit. And then a tax on base eroding payments that would deny a deduction or treaty relief for certain payments unless that payment was subject to, again, an effective tax rate at or above some minimum rate. So I'm going to take those as being the basic ideas. This is what the OECD and the members of the OECD are trying to do. So let's just go back and think, okay, well, how does that fit in this framework then? Okay, so where to pillar, well, let's put pillar 1 and pillar 2 in here. So we start off by saying pillar 1 and pillar 2 are not going to take away the existing structure. So, pretty much all the tax we already collect in under affiliates or wherever they are, and under all the complicated ways we do it, are going to stay there. In addition, pillar 1 is going to introduce some tax where sales are, and pillar 2 is going to introduce some tax where headquarters are. Okay, so I'll be asking, there'd be a test question. If you were my students now, I would say, well, okay, what principle are we using to try and identify where we should be taxing profit? Because like right at the moment, it seems like we're taxing multinational profit pretty much everywhere we can think of, just in case. And that seems to, actually, I think that probably is the principle. So let me relate this to kind of other proposals that are out there in the literature, which you may have come across. So, so my colleagues and I, in a forthcoming book and papers over the last few years, have proposed two reforms: one for a destination-based cash flow tax, which would be based in the place of sales, and the other is a split between routine profit and residual profit. So we call it the residual profit allocation by income. It's a bit of a mouthful. That would also tax routine profits where the function activities are, but it would tax residual profit in the destination country. So there are some other options out there as well. But I want to go back to, what are the principles that we might think apply here? Why would anybody think doing pillar 1 and pillar 2 is a good idea? What principles do we use and what principles should we use? So we don't have time to go all the way back to, real basics, but if we were thinking about fairness, we would start off with an ability to pay and the benefit principle. Okay, where does that get us? Well, I think if we're really serious about ability to pay, I think I would start with the residents of the shareholders. They're the people ultimately who own this business and get the revenues from it and the profits from it. So if we were taxing on a worldwide basis on their personal income, we'd be taxing them on this multinational's profit. Benefit principle, okay, well, that depends, on the benefits that you might be picking up for all your activities. We could talk about both of these at length, but I don't want to waste too much time on those. And the next thing is, apparently, it seems to me that it was invented about 5 or 6 years ago at the beginning of the BEPS project, but apparently, there's a claim that we're actually trying to tax where value is created. Now that seems to me to be both not true and not a very good principle. It's not true because we tax interest where it's received. So unless you think the value is all created in the finance subsidiary, which happens to be lending to the rest of the company, that's not where value is created in my book. Value is created in lots of different places. It's almost impossible to identify where it's created. One place where I think it would be created is where you make a sale to the customer, and that's certainly not part of the existing system. So I think, actually when pushed, Pascal Saint-Amand now actually doesn't really believe in this principle anymore. He does say that, the usefulness of it, which I agree with him, is to say, well, okay, we know that value is not created in some of these tax havens where a lot of the profit is allocated. So if we put it in the negative, we want to say, we don't want to tax, this profit in the place where there's a zero rate jurisdiction where nothing happens. There was no value created there. That's fine. But taking that further and then, trying to figure out where profit is created, where value is created and tax it accordingly seems to me to be not a sensible way forward. So we could, you know, other principles we could say, you know, why are we going to the market country? Well, I'm going to come back to that. I think, you know, the rationale is that there's something in mobile there, which is a customer, and that actually gives us lots of benefits. Should we tax in the country of the parent? So this is, you know, broadly, if we look at if we put the OECD proposals together and we assume the US comes back to the table in due course on pillar 1, we're taxing everywhere. So why do I call this a Marxist view of international tax policy, apart from to kind of exhibit my left-wing credentials? Well, it's actually from Groucho Marx. So those are my principles. If you don't like them, hire others. So we can tax where value is created, we could tax in the market country, we could tax in the country of the parent, we could tax any other place where we think, you know, if we don't think we're actually doing terribly well in collecting what we think is an appropriate revenue. I think, you know, I think that is, you know, that is my summary of what the principles are that is going on in the OECD discussions at the moment. And I look forward to further discussion on those. So let's go a bit further, let's dig a little bit deeper. So in order to do this, so I'm going to refer to my book, and I'm going to shamelessly promote my book for the next 10 minutes as well. So in when I say my book, it's a book with several co-authors, and I'm going to list who they are at the end, I'm afraid. So the way that we approach this is to say, okay, well, let's think about the criteria for evaluating taxes. You know, what criteria would be useful when we're evaluating a tax? You know, we would like a tax to, you know, be as far as possible to be economically efficient. We'd like it to be fair. We like it to be robust to avoidance of profit shifting. We'd like it to, you know, the cost of administration to be as low as possible. And we'd also like it to be incentive compatible. So these are the 5 that we talk about in our book. And, you know, this is, I'm not going to go through all of these in any detail now, but it seems to me a good starting point is actually to say, okay, what do we want from the tax? You know, for a given amount of revenue, we would like a tax to, you know, meet these criteria as far as possible. So I'm going to kind of have these in the back of my mind when I'm thinking about the kind of pillar 2 proposals. So let's go back to what I, you know, hinted at a moment ago. So what would be a good principle for, you know, where we should tax profit? And, you know, to cut a long story short, I would say, well, a good principle for where we should tax profit is to look for somewhere where it can't easily move away from. We can think of that. We could think of the country of residence of the shareholders, for example. So, you know, I own shares in lots of companies around the world, mostly through my pension fund. If I was taxed on those, I'm not going to move anywhere else. I'm not going to move jurisdiction and move to a different country because those multinationals' profits are being allocated to me in the UK. So that would be an example where, you know, the location would be immobile. The other obviously relatively immobile place is going to be where your customers are. And everything within the multinational can move, and some of it can move very easily indeed. So you can move your intellectual property easily, you can move your financing easily, you can even move your factories, you know, relatively easily, and you can certainly move your head office. So, you know, what's the advantage of that is, well, it's going to be more efficient economically because it's not going to distort location choices so much. It's actually going to turn out to be much better in terms of kind of robustness to avoidance. It's probably going to be much cheaper to collect, all of those kind of issues. Okay, so where does pillar 2 come in if we're thinking about that? Well, pillar 2 seems to me to be giving taxing, you know, the way it's set up at least, is giving primary taxing rights to the residence country of the parent. You know, so we have a headquarter parent, and I mean, actually, it's not entirely clear within the proposal as written down exactly which parent gets to tax it. But I'm taking this, and I think this is the way that the discussions are going in the OECD, is that we're actually kind of going to be looking to the ultimate parent. So this says, okay, I mean, in a sense, we're not taxing worldwide profit in the location of the parent, but we are actually allocating more taxing rights to the parent for any income which apparently is arising in places with a low effective tax rate. Does that meet my criteria? No, not in the least. You know, so, you know, what do we see? What have we seen historically when we've tried to implement worldwide taxes? And we've seen effectively, you know, the biggest example is the US, where, multinationals are queuing up to leave the US so they didn't have to pay taxes on dividends that are received back into the US. And as a result, so the US has to kind of put layer and layer of anti-inversion rules in order to stop multinational companies moving out of the US. Is that a sensible? That doesn't seem to me to be a kind of sensible basis on which to organize an international tax system where everybody wants to move out of your country and you're kind of going to make it hard for them. Certainly new companies, you would not want to encourage new businesses to incorporate in a place or their parent in a place where they're going to be taxed on their worldwide income. Let's move somewhere else, guys. So as a principle, the headquarters seems to me to be almost the kind of worst possible place. And at least, you know, if we're thinking about benefit principle or something, you know, where you have the activities of the multinational, there's something going on there, you know, that may give us some basis for taxation. But actually in the parent, the residence of the parent, there may be virtually nothing going on, depending on exactly how we're going to define residence. The shareholders may be somewhere else, all of the activities of the business may be somewhere else, the customers may be somewhere else. Why are we giving taxing rights to this particular jurisdiction? Okay, so that's my starting point. So what is it that this proposal is trying to do? And the answer is that, you know, if you look in the document again, you know, there's like one paragraph which touches on some possible rationales before kind of moving on to the kind of technical issues. So one is combating profit shifting. Okay, so this would be an extension of the BEPS approach. The second is to limit tax competition. So, you know, that's less talked about in the OECD, but I'm sure everybody on this call knows, you know, the corporation tax rates in the world have fallen substantially and continuously over the last 30 years or so. And there's plenty of evidence that that's a result of a process of competition as governments compete with each other, both for inward investment and maybe also for taxable profit. So you know, by having a minimum effective tax rate in the world, you know, this could arguably at least set a limit to the extent to which we might have tax competition. And the other things that gets mentioned are, you know, preventing the proliferation of uncoordinated anti-avoidance measures. I mean, the OECD has some kind of vested interest in, you know, not allowing everybody to do their own thing and actually trying to coordinate there. I'll leave the last one. That one is not actually in the OECD's list, so we could come back to it if people want to talk about it. So it seems to me, however, if we go back to these first two, combating profit shifting and limiting tax competition, these are actually fundamentally different things. And we need to recognize that they're fundamentally different things, and they should lead to fundamentally different taxes. If this is what they're trying to do. So let's look at the profit shifting idea. So, and here's a cite from one of the BEPS papers. And the BEPS approach is say that no or low taxation is not per se a cause of concern, but it becomes so when it is associated with practices that artificially segregate taxable income from the activities that generate it. That's pretty clear. That's what the BEPS process said. And that's what, you know, the BEPS actions were intended to do. But this is all about artificial segregation. Now, you know, if we're thinking that the Pillar 2 GloBE proposal is trying to limit tax competition, that's completely different. This is a very, very different aim of the proposal. And it's just saying, you know, if you have an effective tax rate which is low enough, we want to tax it. We want to prevent that. We don't care whether there's, you know, I mean, if this is the aim, we don't care whether it's to do with artificially segregating taxable income from activities that generate it. It's just that there's a low tax rate. So I think the OECD or the members of the OECD need to decide which one they're going for here. And the answer, you know, I've put this in the title, the substance carve-out idea is, well, okay, so the idea of a substance carve-out is we're only going to apply the GloBE tax if your effective tax rate is not only low, but there's no substance in that jurisdiction either. You know, if we do that, then we're kind of thinking of the profit shifting case. If we're going to apply it, whether there's substance there or not, we're moving to the tax competition case. Of course, there are a whole host of issues about what we might mean by substance being there, which, you know, many of which were kind of explored in the BEPS process. I think the kind of I just wanted to raise this as a fundamental issue. You know, what is it that we are trying to do here? And, you know, that should determine if we can answer that, it might help actually determine the way forward. Next question, and I know I'm probably going on too late already, but let me just say a few things briefly about this. There is a question, who gets to tax this? So let's look at this multinational company as a parent, which has a subsidiary A, which has a subsidiary B, and B is in a low tax jurisdiction. It also has a separate subsidiary C, and C makes a royalty payment to B. So there's some intellectual property or intangible assets in B for which C is making this payment. So under the GloBE proposal, which of these countries gets to tax? Suppose B is paying tax at a very low rate and the effective tax rate is too low. Who gets to tax it? Well, there's two possible parents. There's A as the immediate parent, and then there's the ultimate parent. So there's an issue there as to who gets to tax it. C also gets to not deduct that royalty payment. So there's three possible, if basically everything else in the multinational company, all of those residence places might get to tax this income arising in B. So at the very least, we need kind of fairly clear rules about who's going to implement that. And, the answer to that is also going to, help us think about, how multinationals are going to respond to this and what they're going to move around. If the answer is it's going to be taxed in A, then, the multinational is going to say, well, I'm going to take company A and put that into a jurisdiction which is not implementing the GloBE, for example. So those are the kind of tricks which we might expect to be played. Let's think about effective tax rates. So the kind of basic idea here is there's going to be some threshold of an effective tax rate, maybe something like 10%, which says that, okay, if you have an entity in a jurisdiction which is has an effective tax rate less than 10%, then the parent company is going to get to tax the excess. So if you're paying 4%, then the parent company is going to take the extra 6%. Okay, so I'm not a big fan of these kind of measures of effective tax rates for a number of reasons. But one is the numerator and the other is the denominator. So the numerator, what tax are we including? So we're thinking about taxes on profit, but why limit ourselves to taxes on profit? We know, for example, that we can, and there's equivalencies between different kinds of taxes. So let's take VAT. Okay, so we have Rita here. Rita knows everything about VAT. So if you take VAT and make a deduction for labor costs, what do you get? You get a destination-based cash flow tax, which is a tax on profit. So we could recreate a VAT with a tax on profit, the DBCFT, and a tax on labor income. Okay, so suppose this country has got a VAT. Okay, the VAT is probably not going to be part of this effective tax rate calculation, but that country could take its VAT and split it into destination-based cash flow tax and a tax on labor income, and the destination-based cash flow tax probably would count in for this effective tax rate. So, what tax we're talking about doesn't matter. What profit is even more tricky, I think. So if the profit were actually simply the host country tax base, then the effective tax rate would just be the statutory rate. In principle, more or less at least, ignoring losses and some issues. So why don't we just take the statutory rate? Well, presumably because we think that's not a good measure of profit. Okay, but then what is a good measure of profit? We could go and look at what the parent company definition would be, and that's, CSC rules tend to do that, but that's extraordinarily complicated, and it would be much more complicated if the parent company is doing that for a whole host of entities in different jurisdictions. Or, what the OECD is thinking about is using financial accounts here, and I think that raises a whole host of other issues, which I won't go into at this point. So it's not clear to me that a measure of effective tax rate actually tells us that much about what the OECD might be concerned about, which fundamentally is probably to do with profit shifting in this case. Quite a lot of papers try and use the ETR as a measure of profit shifting. I think we could talk about that as well as to whether those are really persuasive as a measure. There are a lot of issues that the OECD thinks about in terms of blending, and the basic issue here is, are we going to apply the GloBE proposal on an entity by entity basis, on a jurisdiction by jurisdiction basis, or on a global basis for the multinational company as a whole. Typically, I think, you know, the literature and the OECD papers just kind of jump into all the kind of, you know, issues of, you know, the technicalities of how easy it is to do each of these. I think we should take a step back and say, you know, what's the point? What are we trying to achieve here? In particular, you know, why apply this at the global level? So this would be saying, you know, we're going to take a resident multinational company, and if its aggregate effective tax rate in the whole world is less than 10%, then we're going to tax it a bit more. Okay, well, you know, exactly what problem is that supposed to be addressing? You know, it probably would be less costly to administer, but it's going to be also much less effective. So that's another issue. There's an issue of harmonization. You know, is it required that actually all countries implementing this are going to have the same definition of the tax base when they do their effective tax rate calculation? Are they all going to have the same threshold? If they don't, then what kind of problems are going to arise? There's going to be competition again between governments. There's going to be companies moving around to try and get the best deal because, you know, somebody's threshold is lower than somebody else's threshold. So, you know, our experience with the CCCTB in the EU is not promising in terms of trying to define a tax base which we're going to apply. This is going to be doing it in the entire world. So I guess the question here is, you know, how big are the problems going to be if we don't fully harmonize across essentially the entire world? And I think the answer is probably quite considerable. And let's think about that a bit more when we think about incentive compatibility. So by incentive compatibility, I'm really thinking in terms of, you know, how stable is this? Is there incentives for governments and countries not to join this? Or if they are going to join, are they going to implement it in some kind of weaker form rather than a stronger form? And I've said we've had 3 decades of tax competition where governments are willing to give up revenue in order to be more attractive for inward investment. You know, my own country in the UK is, you know, a great example of that. You know, when I started working on corporation taxes a very long time ago, the UK corporation tax rate was 52%. Now it's 19%. And, you know, the same is true in many other countries. So the question is, you know, is there an incentive for the UK to comply with this, for example? And, you know, even if they agree in the first place, do they have incentive for some future government to renege on that promise? So suppose France and Germany say, we agree, we're going to introduce the GloBE. What is the best policy for the UK? So there's 2 options. One is they say, oh yeah, you're right, we should do that as well. And that would help with tax competition, profit shifting and so on. On the other is to send a note of thanks to the French and German governments and send a different note to multinationals resident in those 2 countries, inviting them to move to the UK. So, you know, given the competitive nature of the UK, I think the latter is actually quite likely. So what is it that France and Germany could do to prevent that? We could talk about that again, maybe in the discussion element of this. So I've talked about this. Does the GloBE meet the GloBE? Do we need everybody to do this or not? If there are holes, if the UK decides it's not going to do it, how bad a problem is that for France and Germany? And unless France and Germany can stop their multinationals leaving, I suggest actually is quite a big problem. So actually we probably do need, you know, a large part of the world to do this if it's going to be effective in the way that the OECD and its members hope that it's going to be. So that's a very quick run through this. My conclusions, I thought I wouldn't hold back here. It's a bad idea. It probably won't achieve its objectives, not that we really are sure what they are, but it definitely will add to the already mind-boggling complexity of the international tax system. Why are we even thinking about this? You know, why would anybody think this is a good idea, other than perhaps a small number of countries who think they might actually gain from this? We've been trying to do this for ages, and they would much rather have some cover of trying to persuade everybody else to do it. They see pillar 1 and pillar 2 as a kind of as a way of trying to get what they would like to have when other countries are trying to do something. So, you know, if one country wants to move towards the taxing in the market, others want to move towards taxing the parent, we could have some unholy compromise between the 2 where you know, everybody gets what they want, and we get an even worse international tax system than we have at the moment. So just to finish, sorry, and this is shameless, but I'm going to just advertise a forthcoming book which addresses some of these issues in much more detail. It's with 5 co-authors, Alan Auerbach, Michael Keane, Paul Easthouse, Wolfgang Schön, John Vella. We've been working on it for years, and it is finally coming out this autumn, and I recommend it to everybody. So with that, I will stop sharing my screen, so long as everybody takes a quick screenshot of this first. Thank you again for the opportunity to speak, and I look forward to a discussion.